Hi everyone, welcome to our first webinar of 2017. Thanks for joining us. We're very excited to have Rob Jones from Peloton Partners presenting today on unlocking the value in your financial planning business. But first, some housekeeping. This webinar is being recorded and the slides and the recording will be sent to you after the webinar. We encourage you to please put any questions in the chat box throughout the presentation and we'll answer them at the end of the webinar. If you're posting on social, make sure to use the hashtag NetwealthInvest or tweet at NetwealthInvest. And there will also be CPD points available and a questionnaire will be sent after the webinar. Today we'll be hearing from Rob Jones, owner and key principal of Peloton Partners. Peloton Partners is a consulting company that specialises in helping financial planners in various facets of their business. Rob has over 15 years' experience working in financial planning businesses, including general management and senior executive roles at Shadford Financial Group and the Money Managers. Today, he'll be sharing his research and insights into how to successfully grow your business. I'll now pass it over to Rob.
Good morning, everyone, and firstly, thank you very much for agreeing to give up your important time to come and listen to this webinar and watch on screen. It's the first for me. I've never done one of these before, so please provide some feedback if you think I'm talking too fast, too slow, or indeed too boring. I'm just hoping to share as much as we possibly can with you in the short time that we have together regarding some work that we've been doing with over 50 firms this past few years in the Peloton Partners era. We've had the privilege of working with many firms, both large and small, and I suppose the greatest privilege is the fact that we have individually interviewed over 100 advisors, about 125 financial planners across this country, and we've listened to them tell us about each of their active clients, because at the end of the day we end up, as far as the Peloton process is concerned, we end up mapping the end client relationship with the financial planning firm. It's a critical aspect of what we do. But just in doing that, we have amazed at the wealth of value that advisors around this country provide to their clients. It's extraordinary. It's times like this that we wish that ASIC and anyone else who has been a bit of a detractor in this industry would come and listen to some of these stories of advisors walking back through the history of the relationship with their clients and everything else that they have done for them, and just tracing the advice that's been provided to these clients. It is nothing short of exemplary. It is nothing short of massive value add, and it'd be good for the regulator and for clients alike just to hear what financial advisors do. As you can tell, we are very strong supporters of financial advice in this country. So I'll just kick on without any further ado. We've titled this 3 pillars of a successful financial planning business, and really it's really 3 themes. It's some themes that we wish to come across, and what I want to talk to you today about is understanding and uncovering the full value in your business. Now, this is something we're very, very passionate about, and most financial planning businesses have value to be unearthed. The second point is we want to restate your value we think you should restate your value as comprising both intangible and tangible service elements, and we're going to break down both of those elements for you today. And thirdly, it's a hot topic, and it's repricing and looking at pricing it to the end client and ensuring that you, the advisor, and the business and the shareholders and all stakeholders get their fair share, so that profit per client is an important thing, profit at the business level, but delivering value back to the client is a critical component. And when all of those things marry together and harmonise, it just works. So unlocking the value within your firm. So this is a question that we occasionally ask advisors every time we either get a new engagement or we have the privilege to be able to speak to a group of advisors, is to ask them the question of how much value do they think is sitting in their business. And some people come up with some fairly miraculous numbers, but we can tell you without a shadow of a doubt that the number you're about to see is the facts of the value that can be unearthed in the average financial planning business that we have advised this past 3 years. That is 50 of these firms. And that number to unlock is 52% increase in profit. Now, it may sound a little bit outlandish to some, and some of you may think, well, that's impossible, and some of you may agree with that. But I can assure you of the firms that we have managed and advised over this past 3 years, this is the number that we have worked out with them. That is the value that's sitting in their business right now, additional value that they could unearth themselves. And if they did, it can do some extraordinary things to their business, as well as strengthening the relationship with the end client. So keep that in mind, if you will, that 52% increase in underlying profit is what the average uplift that is out there. Simple example, if you're currently delivering a $200,000 profit, then there's an extra $100,000 sitting in there somewhere to be unearthed for you at the end of the day. So this next section is just to perhaps help you to identify yourself, perhaps, in some of these numbers. It is the numbers of our clients. So the next slide will give you the facts around the sort of firms that we've been dealing with. They are located, as you can see there, in regional parts of this great country, in the major capital cities and all over. They vary in all sizes. So we've dealt with clients that are firms that are in the startup phase, to firms that are quite mature in terms of revenue. Profitability is a large range in profitability of these firms. A big number of clients, and we'll talk about clients, active versus passive clients, a little bit later, but 50 to 4,000 clients. The firm with 4,000, by the way, 3,000 of those clients are inactive and passive. 1,000 of them are actually active on that particular firm. Full-time equivalent staff between 2 and 35, FUM, if you want to use FUM as a measure, between 50 and 500 million. And generally the length of tenure of our clients is between 2 and 25 years. So it ranges from 25 years down to 2. The average is around about 12 years in business. So this is just to let you know that these are the sorts of groups we've been dealing with. And by the way, some of them are financial planning and risk firms, or risk firms with a financial planning element, or they're accounting firms with a big financial planning element, or a financial planning business with a big accounting business attached to it. So they're all shapes and sizes and all variants that are typically discovered. Now, this is a big one for us. So this is a breakdown of those 50 firms and the exact normalised profit margins that these firms are presently earning year in, year out, certainly over the average of the last 5 years. The red one, the red colour, we've classified that as good profit margin, although some of those clients are definitely in the not good category. They're at the bottom end of 0 to 10%, but we've classified a good margin around that 20% or lower. There's 43% of that 50 firms that we've managed have a better, what we've classified as a better profit margin. That's a normalised margin between 20 and 30% going back to the owners. And there's 18% of that 50 odd firms that we've classified as having the best margins, with normalised profit margins above 30% sustainably. And the average for the Peloton advised firms is around about 24%. Coincidentally, that's not far off the average of the Australian market in 2015, and very similar to a comparable set of firms in the US, which were around about 23% over the same period. But about 24% is the average at Peloton before we dealt with them. But this is the big one for us, and it probably looks a little bit confusing, so please let me step you through. It's what makes up profit that's really important to us. It's one thing to have profit, but it's the makeup of the profit that we're particularly interested in. And I can tell you with a high degree of accuracy that those firms that have the better profit margins, above 30%, only 5 or 6% of that profit is made up of upfront revenue or passive revenue, or whichever you want to call passive revenue. I call that rebates, old legacy trail commissions, whatever makes up that passive revenue number, and also upfront revenue. So those firms have got a fantastic buffer. They've got a buffer of at least 24, 25%. So they can cover their ongoing expenses from their ongoing revenue with a buffer. So as profit starts to fall down, we notice that the reliance on upfront revenue starts to tick up quite considerably. And in that second bucket, that are 20 to 30% profit margins, nearly half of the profit has been delivered by upfront revenue or passive revenue. And down the bottom, those firms that are sort of in that sub 20% profit margin territory, nearly all of the profit they're delivering is coming from upfront revenue. In other words, or passive revenue. In other words, they are not able to adequately cover their expenses, their ongoing expenses with their ongoing revenue, and certainly there's not a sufficient buffer there. They're barely able to cover it. So that identifies, if you like, the 50 firms that we've been dealing with this past 3 years and some numbers that sit around them. Another fact is that 42.9% of them, or a fairly good portion, are now charging fully flat fixed fees for their ongoing financial planning service. 3% of them still charge a percentage of FUM as the primary fee charged to clients. And the balance obviously is a combination. So 42.9% is basically a combination of fixed fees and percentage of fees. And I suppose that tells us a couple of things. Firstly, there's no real consistency around pricing that we have found in some firms, not all firms, and therefore a bit of confusion reigns. And the second point, which is interesting, is that 5 years ago, that fixed fee bucket, if you like, that fixed fee segment of 42.9% of firms was only about 18%. And what we've seen is this quite significant shift this past 5 years towards a fixed fee engagement with clients. That trend is still continuing. So let's just talk about some of the recurring themes. Now, some of these might be present in your own firm, some of these may not at all, but these are the recurring themes that we found in those 50 businesses when we aggregated all of the good and bad bits about each of them. Firstly, unprofitable clients is a significant one. Unprofitable clients, and up to 50% we found in some of our clients. Some are more, some are less, but when we properly cost these clients to the business, there is a huge portion that are unprofitable or at a break-even level to the business, which means there's also a significant portion that are subsidising the rest of the clients. The second recurring theme is legacy fees, and not surprising, it's very much linked to unprofitable clients. So many firms are still operating a legacy fee model that they may have put in place a number of years ago, may have changed, but they may not have swept back through all of their clients and fixed them all up. And we found that was a significant contributor to unprofitable clients, and another recurring theme inside these practices. Legacy fees. The third theme at the moment is change, and we acknowledge, and we're the first ones to put our hand up, we were like that inside our own financial planning practice before joining Peloton. You know, we found change difficult, and we get it. Running projects and stopping what you're doing and focusing on certain parts of the business when you're already so busy is a really difficult thing to do, and we understand that change and the challenge of change is certainly present in the firms that we've been dealing with today. Maintenance mode, we've termed this next bit, and this theme relates to the fact that a lot of firms are pretty much just doing what they were doing the year before or the year before that. And again, they're growing, but they're not growing very significantly, and they're not really changing too much about what they've done historically, so that if there are any issues inside their business, they're sort of perpetuating those issues in a way because they're not making too many changes that perhaps they should start to think about. So maintenance mode is another recurring theme. Blind inertia. Now, this one relates to the fact that a lot of the clients that we have dealt with, a lot of those firms, they sort of believe that you know, we'll be okay. Things will keep moving the way they need to. You know, we hope that, you know, that we're going to move on and we're going to continue to grow and so forth. And, you know, hope is not a strategy, as we all know. So there's a little bit of perhaps ignorance, if I can use that term, that sort of can describe some firms in terms of blind inertia, hoping that everything will just go up. Business plans, this is a big one. We've seen the 1 pages, we've seen the 50 pages, by the way, and all sort of variations in between, some really good and detailed, some not so good, but quite frankly just as good in application. And I suppose the thing that sort of grabbed our attention the most is that schematic you can see up there, is that Most plans we see are very optimistic, as perhaps they should be, but in reality what happens is the schematic at the bottom, and that's a fact that things don't always go to plan, and not many of the plans we saw adequately dealt with, let's say, a key advisor leaving, or dealt with a number of clients leaving, or dealt with a significant legislative impact, or dealt with ever-changing SOA templates or technology in the firm and everything else. So we're just highlighting the fact that they do change, and it is hard to operate sometimes. And the final one we've termed the corporatisation, or the building blocks. And I just want to go through this specifically. There are some building blocks that every firm should have, a set of building blocks. We've called them corporatisation steps, if you like. And if the foundation isn't right to begin with, you start to see the fractures. You start to see the things that can crumble and cause a few difficulties. And I've just sort of highlighted these building blocks separately for you so that you can get a sense of what we talk about. And I suppose if I was to start my financial planning business over again, knowing the mistakes that I made with it, I would try to nail the following things, I suppose, and get this right. And as odd as it sounds, the first major part of that building block is who are you, getting your identity right. And by that I mean, are you in the business of organic growth, or are you an acquisitive growth builder, or are you both? They are very different. We've been on the side of 25 mergers and acquisitions, either as buyer or seller, and I can tell you that growing the business organically and doing an acquisition are two very different skill sets in my view, and not always easy. Some firms do it great, but a lot don't. But getting that down right from the outset, what sort of person are you, what are you capable of doing, and do you want to grow organically or do you want to buy? Are you all things to all people? Or is there a genuine purple patch that you fit with the best, and therefore by definition perhaps will advise the best and perhaps have the greatest level of interaction with your clients as a result? And if you do, then remove other distractions. It may sound a little bit too disciplined or a little bit too direct, but when you're focused and when you enjoy it, it's amazing what you do. So where you can find those similar clients, and maybe don't deal with those that you really don't enjoy. And obviously stick to your strengths and resist the urge to follow the crowd. Crowds do often get it wrong, and we've seen some of the firms that we've worked with that have followed the crowd and sort of thought this was the next best thing, and it hasn't quite worked because it wasn't right for them. Clients is another big theme, so understanding your clients. Clients are not born equal. We don't believe they should be treated that way either, even though we know it's efficient to be able to run things in a similar way. There is an opportunity to individualise your client needs because they are different. And certainly from a pricing point of view and servicing models, they need to be able to flex with the changing complexity, needs and expectations of clients, but always be profitable to you. The one thing that you all know, I'm quite certain, is that all of your clients are not the same. You'll have clients that present with a high degree of complexity, or they're quite needy, they're quite pushy. They may want to see you on a monthly basis. They may be quite demanding in terms of your time. And you may charge them a certain way, but then you've got another client who is the easiest to work with, and you tell us that this client is so simple in terms of their needs, but they might look similar from a structural point of view to that other client who is actually quite complex, quite needy, and very different. And so you need to be able to have a pricing and service model that can flex with those types of clients, in our view. And look, this doesn't really relate to clients, but it is in every single back office we've seen, and that is inefficiencies. They're everywhere. There is at least 20 to 40% of an efficiency gain that you could make in your office by an immediate impact, just by being able to reduce the wasted time that is inside every practice. We've all got them though. It's just making sure you know where the wastage is and dealing with it. Your team is such a critical part. Obviously, these are obvious statements too. Find the right people, develop the right people. We know that 25% of the time of the people we've been working with have been lost on the wrong staff, and that's a lot of time in building the business and servicing existing clients. Like clients, employees are not the same. Play to their strengths. We've seen examples of some firms that have treated all of their advisors, their client-facing advisors, exactly the same in terms of remuneration, in terms of bonus structures, in terms of expectation of getting new business. And yet when we go and speak to those advisors, there is such clear distinctions between them that it's ridiculous to treat them all the same. Some really enjoy looking after clients. That is their strength, and that's where they should be focused, and the firm should acknowledge and respect it. Others really love getting out there and finding new business, developing relationships, having time to speak at seminars and whatnot. They need to be dealt with as well, and a package needs to be able to support them, because that's a fantastic attribute as well. But the point being is not all employees are the same. One of the biggest ones for me is know the numbers, and then know the numbers again. I'm well aware that technology doesn't always make it easy for us. X-Plan people tell me about, other CRM systems and other data feeds that don't often work, but the numbers are so critical. And again, talking about the firms that we've dealt with, so we have direct experience of them, they don't know their numbers well at all. And you know, this is a bit of a condemnation, not necessarily on advisors, but on technology is where I'm pointing at. That having those tools and having the ability to scrutinise your client base the way you want to is such a critical component of what you need to be able to run your business successfully and know the numbers all the time. When you don't know them, that's where things start to fall over a bit. That second point there, rid the business, if you can, of those lower quality revenue streams that we referenced a bit earlier. Mainly around legacy trail commission, where you can, of course. You know, we're starting to see rebates and overrides and all of that phase out, as you know, even if they're grandfathered. Can we do something about it? Because we know that the legislator's pen is going to force us at some point in time to do something about that, and that's going to happen. So where possible, rid yourself of those lower quality revenue streams. And the bottom statement is consistent with what we said a little bit earlier too, around ensuring where you can that there's a genuine 25% profit margin running in your business just from your ongoing service. The rest of that can be made up by upfront revenue, but having that buffer is really critical, in particular where there are market downturns and where you're just having a bad year in terms of new business. So that for us is the building blocks, if you like, or the corporatisation steps. I just want to take you now through three firms of ours, of Peloton. If they're on any of, I don't identify any clients, of course, but if any of my clients are on, I'll be interested to, if you try and guess who you are, but you may or may not be in this list. But this is three firms that we've been working with. I'll just take you through them briefly. Firm one has been 10 months in terms of the Peloton process. 6 staff, 90 odd million of FUM, if you want to use FUM as a measure, roughly generating 850k, have an EBIT of 220k at present, so they're running a margin around 25%. In the last 12 months, in fact, it's not 10 months, they're now 12 months in, sorry, I should have updated that, a couple of months out, but they're now 12 months down, and they've just hit their $1 million threshold that they were aiming for this last 12 months, just from their existing clients, by the way. They've achieved a 400k normalised profit uplift, and that's a pretty significant result for them. At a firm a little bit larger than them, a few more people to deal with, a few more team members, a lot more clients, turning over, you know, a $3 million mark, profit around that 850k again. There's that consistent sort of 27% margin that's flowing through. They've gone through a fairly significant exercise as well. Their EBIT margin is roughly around 34 at the moment. I understand, speaking to them recently, that it's a little bit better than that, but around 34, 35, which is definitely achievable for them, and one that we agreed together was their short-term target, and they've certainly hit that. And here's another one. It is bigger again, but it doesn't matter the size of the firms. This one started with around 4.5 million, profit margin of 1.2, around 26%, 19 staff, 800 ongoing active clients across all the various segments that you would expect. And they sort of were able to transition over the course of a 12-month period and pick up quite a significant uplift in their profit margin, both as a percentage and a raw number. And we congratulate all of them who did an outstanding job. But I suppose the reason to show you this is just to give an example that it doesn't matter if you're a smaller business or even a one-manner, doesn't matter at all, or a very significant business. There is that latent value that's sitting inside those firms, and it should be yours. So now we just want to talk about your clients and what they value the most. And if you talk to them, you should know. If you've seen all the surveys in the industry over the past 20 years, you definitely will acknowledge that some of the things that they want from us are perhaps here. Is it knowledge, confidence, or our professional reputation? Is it our technical skills? Is it our investment return? Is it the cost of what we're doing? Is it the quality of our advice? Is it all or none of them? And as the survey says, and pretty much every survey that's come out says this, is that clients value the most is the intangible value that their advisor delivers for them. So that relationship to them is really important. But what on earth is intangible value, and how do you communicate that to your clients? So intangibles definitely, and some of the hot points for your clients are these statements here, these one words here: commitment, listening, trust, empathy, confidence, stewardship, empowering. All of those sort of nice words really are the connectors, if you like, between your clients and what you do for them. It is often us as advisors that don't value what we deliver as much as our clients do, and trust me, your clients value it greatly and often well beyond what you value it. But we need to be able to convert those statements into, or those one-worders into, just a couple of statements. And I've just written a few up here for you as a bit of a guide. They're we statements. The first one is: we are committed to understanding your needs and to give you the peace of mind that your financial affairs will be in order to enable you to live the life you choose. We are here to help you identify and clarify your unmet goals and aspirations. We are here to take stewardship over your financial goals and aspirations with you. We are here when you need us the most, at a time of a loved one passing or suffering a serious illness or disability. And finally, we are here on an ongoing basis to help you make informed decisions regarding your financial affairs throughout the course of planned or unplanned changes. They may seem obvious to you, these statements, but I can guarantee you we have not seen them clearly stated in any engagement process that our clients have with their clients. So even though they're obvious, even though your clients really believe that this is the reason, and these are the reasons that they have engaged with you, because they have opted to receive a financial planning advice service, these are the fundamental reasons why they do. Yes, return's important. Yes, taxation management is important, but this is the real reason for it. But we don't often see it stated that way. So we contend that part of your client value proposition should be a combination of intangible and tangible value, as simple as that. The intangible value should be the core of the client value proposition. Intangible value is how you make clients feel. That's what they value the most, that's clear. And this retention mindset is really important. Clients believe, once this has been communicated to them accurately and with conviction, that they're actually retaining you. That's their mindset. They're already retaining you. They're not just coming to you for one piece of advice here, there. They're actually retaining you to help them with something they find difficult or have no time or have no skill set in. That's the reason they're coming to you. So therefore, they're retaining your service. Tangible value is obviously what you do for your clients. We contend, again, that your value proposition should be a combination of both intangible and tangible value components. Pricing. Pricing's the big one. So let's just run through what is best, and perhaps these next few will identify all of you in the room, but we've seen a simple percentage of FUM model, i.e. a flat 1% of FUM. We've seen the tiered percentage of FUM starting low, starting high I should say, up to 250k there's a 1.2%, and then trailing down as the client's FUM grows. Obviously there's the fixed side of it as well, so fixed fees at say $4,000 for a segment or $2,000, whatever the case may be. We've seen fixed fees that are based on FUM, that are FUM linked, so under 250, fixed fee of 2,500 as you can see there, and beyond $1 million, a $10,000 fixed fee. So a combination of them all, or a hybrid of them all. There are that many different combinations going out there, and there are some firms, believe it or not, that actually have all of those four present in their legacy client base. There's a reason that they have those present in their legacy client base, and there's a reason that it's been so confused perhaps over time, is that we've had a top-down rather than a bottom-up approach. So many of us, and certainly my firm, the Money Managers, was one of those where we had and basically adopted a percentage-based fee. That was the norm at the time. We charged clients a 1.1% trailing down fee on FUM. Bang, that was it. We perhaps didn't really know any better. This was 15 years ago, 10 years ago. We hadn't really been challenged too much by clients with that, but that was what we were doing. But we were often just replicating what the product manufacturers were doing. And we definitely imposed a pricing model on our clients and our cost structures via that top-down approach rather than the other way. And as the business grew, we definitely had mispricing in ours, and we saw it in many of our clients as well, and this simply doesn't work any longer. You can't really run a business like that where it is quite confusing. No one can identify their mispriced clients. So why doesn't it work over time? This is an actual conversation with an advisory group that told us this is how they originally sort of conceived their pricing model. You know, we don't have a pricing model. We chose a simple model. They did a 1% flat fee plus GST on every dollar of FUM. That sort of meant that high balance clients definitely subsidised the lower clients. That led to discretionary pricing taking over because often the advisor or the owner of the firm decided to, in some circumstances, give a different client a different rate for some reason, but it happens, a bit of a discount perhaps, or what have you. The profit margins are definitely impacted when that is the case, so we know that the minute you do that, you start playing around with your own return. And they decided then to actually put a tiered percentage of FUM in because they were getting a bit of heat from some clients who said it wasn't fair when they were being penalised by putting new money in their account. By putting in the tiered percentage of FUM for new clients, they didn't sweep back through their existing clients, and therefore more inequity and complexity was present. Therefore more discretion kicked in. They started to give some fee holidays to some clients, fixed percentages at a much lower rate, tiered percentages at a much lower rate for certain clients. More unprofitable clients, they couldn't tell us which ones were unprofitable or profitable. Again, more complexity, more confusion. The business is now effectively operating a hybrid model amongst all of their clients. So, you know, a fixed fee engagement was in there as well as a tiered percentage of FUM and a flat percentage of FUM as well. And that discretionary pricing effectively amounted to a business within a business. And at one extreme end, there were 5 advisors in one firm that were effectively working off the same pricing guide, but priced clients completely differently to each other. And it was definitely a business within a business operating. And they were a fantastic financial planning firm. There's no doubt about what they were doing at the client end was brilliant, but they were pricing it so remarkably different, it was causing problems. That had to be fixed. How are we for time? So how to determine a pricing model for your firm, and it's never easy. And we have at Peloton currently put in place 40 different fee structures for our clients, quite a few, and that's been going really well. But it just shows you if there's 40, how many different pricing models there are and how they need to be tailored to those firms, because no two firms are the same. They're all different. Their approach is different, their cost structures are different, their target markets are different, their clients are different. So we had to employ a different pricing strategy for them. But most of our strategies have been fixed fees. I'll talk about that later, but we had to start somewhere. So we think that you need to undertake a deep analysis of your clients and your cost structures, and that'll guide you to your model. Custom fitting a pricing model to your clients and your costs works very well. Delivers a consistent profit per client, and it can flex with the changing client and business needs. So that bottom-up approach really works. I'll just take you through an actual case study of one of our clients. They started their business, as you can see, $840,000 of revenue. That included upfronts as well. Normalised EBIT around 240k, profit margin 28%, about 239 clients. They were mostly active clients, just a very small percentage of passive clients in this firm. They had 5 full-time equivalent staff. There's about 6 or 7 in the business, but 5 FTE, 2 client-facing advisors. FUM, even though FUM's not the biggest determinant here, that was around 90 to 100 million mark at the time. That EBIT assumed a normalised salary for the principal, by the way, so that's why that little mark is there, asterisk is there beside normalised margin, and the profit margin, that included about 50% of upfront or one-off revenue sources. So they wanted to target around about 40%. Now, there's a reason for them wanting to target 40%. There was a reason that the owner needed a mark around that, and it's not necessarily being greedy at all. It's actually quite reasonable, and he was looking for that return because he had other shareholders within the business who are also seeking a similar return profile. So we had to look at obviously the firm costs. We had to look at CPI and how that has impacted that firm over the last few years, and to take a view of where their costs line were definitely trending over the next 4 to 5 years, and in order to set a number in place. And so the simple calculation meant that this firm needed to a $1.1 million ongoing revenue number. They're currently at 840. Sorry, that was upfronts as well. So they had to go from 840 to 1.1. There was a $260,000 revenue shortfall for this particular firm. So there's the targets again. That was our job to do with our client. The shortfall was 260. We looked at 3 different pricing models. I'll just run you through. So 1.25% of FUM. We looked at that. We built a hybrid model. Coincidentally, this firm ran a hybrid model. So that middle section there of 1.33% of FUM, 0 to 750K clients, $10,000 per annum for clients that ranged in FUM from 750 to 2 mil, and they charged clients at 0.5, a flat 0.5 above 2 mil. They had a variation of that, but that was effectively their current pricing model. But that numbers there would have gotten the result. Equally, we looked at a fixed fee option based on 3 client segments that had a fixed service package that differentiated inside each package, and we applied a $200 per month, $400 per month, or $800 per month ex-GST fee structure. That then produced the following. Basically all 3 generally achieved the objective of that shortfall, a little bit more, a little bit less in some cases, but roundabouts they made it. You can see that option 2 there was the highest one, generating $280,000. Option 1 generated $225,000. Option 3 was $250,000. But this is only one part of the equation, of course, because we need to look at a couple of other scorecards. So just taking this a step further, you'll see there that the revenue uplift, we ranked them then. So option 1, which was $225,000, was good. But the best one was option 2 at $280,000. Then we had to look through some risk analysis. So the first risk analysis score for us is client disruption, and that is changing clients from effectively the current model they're on to a new one, and what that might mean for them in terms of the explanatory power of that, and explaining why the firm has gone down that path to change their model. So option 1, there was a high disruption score as well, because there are a number of clients, especially at the high end, that were going to get a very significant fee increase. And the lowest one was option 3, because the fixed fee segment that we're looking at, the 2, 4, 4, 8, 9, 6, we're able to put clients into the various buckets that made sense once the advisor went through and mapped each client, and we're able to then smooth out those fee increases a little bit so that it wasn't such a massive impact to them. Therefore, this client disruption score went down to low. And complexity, I mean, a straight 1% or 1.25% of FUM is relatively low complexity, believe it or not. It's just a straight easy thing to calculate. A highly complex one was definitely option 2, because it had a fixed fee plus a percentage fee hybrid in there. Model 3, fixed fee, but because there are 3 tiers, there's a moderate complexity rating to attach there. It may not surprise you that we went with option 3. They scored better generally with lower client disruption, and it had a moderate complexity rating as well. So we basically delivered that for the firm. So I'll just, excuse me while I have a quick drink. So we're just finishing up now, and I just wanted to take you briefly to the Peloton process before we tackle any questions, if there are any. But we do 2 things as a firm. We keep it simple. We are simple people, but very simple people. But basically, the first job is a simple consulting job. It's not so simple. We basically get a whole heap of data from you that's very relevant to your business, so your financial side, your operational side, your client side in particular, and some data around your team and how you deploy your team. We then are able to identify some of the issues that are in your firm, certainly be able to identify a potential profit gap, and we might be able to identify exactly what the potential uplift is for your firm based on that similar scorecard that we brought up before. It's a really important phase. It's one that tells us the number. We also do evaluation for our clients in there as well, so they get a sense of where their value sits right now in the marketplace, as opposed to a valuation that has our changes or our suggested recommended changes fully implemented within the business, just to give you a sense of what it looks like now and in the next phase. And then, of course, there's no point in doing all that if you can't deliver it. So this is the bit we're obsessive about. This is the main part, the main reason why Peloton exists, is the doing. So we value our results, and so do our clients in terms of the doing. We don't let the business just walk away with a big number sitting there with, yeah, okay, well, how are we going to get this, and as if we're going to get that. We do it with you. We stand beside the firm. We construct the plan. We construct the communication piece to the client. We do the client segmentation for you. We price your service proposition. We test all the different scenarios out, and then we map every single target existing client to their own individual transition. And if any of my clients are on this webinar, if you will testify to how, yes, it's an exhausting process, that client mapping, but it's probably one of the most valuable exercises you'll ever go through in terms of tracing the relationship of an existing client back and then deciding exactly where that client needs to sit in terms of their own individual transition. So the doing is really important, and we stay with the firm for 12 months. We monitor every week and post results every week, and we deal with objections handling and all sorts of things. So that's Peloton. It's an I focus, and it's I deliver, and it gets results. Little disclaimer for you all, which is an important part, and we'll just throw it open now if there are any questions. I'll just read a couple here that are quite consistent. So could you elaborate a little further on what are the metrics used to determine what a profitable client is? Oh, excellent question. So there's a couple of questions around that, breaking down what the metrics are to determine what a profitable client is. Really good. So it's not until we're able to really understand the firm, its historical costs, its current costs, its projected costs, and then break down generally the three clear segments that perhaps are evident in most financial planning practices, that we can properly attribute a profit margin. And it won't come any surprise to you that once we simply do a basic allocation of costs to every single client, but then we add a factor inside each segment. So let's call them silver clients, if you like, at say $2,400 per annum, typically, and only typically. They are generally, their needs are generally lower than some others. Their circumstances are generally not as complex. And when we're able to pair the tangible service offer to that as well, to the basic costs of servicing the client, we can quickly work out whether or not that client is a profitable relationship or whether it's not. And then as we go through each segment, we do the same thing. What are the complexity traits? What are the service needs and expectations of that client group compared to the one before, compared to the ones at the high end? And it is a bit arbitrary. It's never a perfect rocket science, but it is a far more defensible guide to be able to have a genuine conversation with your client if and when they do ask you the question around costs. How have you worked out my cost? So we do two things: a cost allocation, a basic cost allocation, and then inside each segment we get generally a description, a definition of the types of clients in those segments, and we're able to apply a complexity factor that equates to time spent with the client, that equates to the amount of research that we may need to do for that particular client, and we bring that back to a dollar amount and we apply that to that segment. We've got a whole stack of more questions here. I hope that has answered that. I can certainly go into it with you individually over the phone at a later time if you wish. Sorry, we're just reading through some. Any more information on how to sell the intangibles? Fantastic, a great question, and it's the one that again wins people over. And I suppose the only best way to answer that is that with absolute conviction. It may sound odd, but we believe every advisor, again, as I said earlier, every advisor we've come across is so good at what they do, but they're so poor, if I may say, at explaining their value to a client, linking those we statements that we talked about earlier to a situation that one of your existing clients has had in the past or even a new client that comes through to you, they're coming to you for a reason, but being able to link that to them directly and sell that intangible value and the real reason why you are here is that just like the firemen that we see sitting in their firehouses and we drive past, they're doing nothing, they're having a sleep or whatever they're doing, and we think our taxpayers' dollars are going there. Their true value comes out very clearly when they go and put the fire out and save our children. And it's, financial planning, I know it's an odd thing to say, but financial planning in a way is just that. There are times when it peaks, and it's often at the time when our clients are at their most distressed. It's where we come to the fore every single time. It's where advisors put down the phone and start the doing, and they'll do incredible things. They won't just visit family, they'll go in and talk to all stakeholders involved in their client's world. And that's impressive to see. They'll deal with all family members. They'll take calls for days on end when there's been a serious illness or a death. These are the things that we value. These are the things that you've got to get out on the table, and these are the things that we believe are stapled to those intangible we statements. How do you determine normalised salary? Another good question that someone has asked for advisor and owners. I can tell you with a shadow of a doubt that if you are a principal advisor and running your own business and you are the manager as well, that $175,000 is the salary that you would be on if we were to come in and buy your business. I wouldn't do it for anything less. So between $175,000 to $200,000 normalised advisor, principal advisor salaries in this country. Easy. Below that for non-principal advisors, normalising advisors' salaries, and look, we've seen them all, and we get asked this a lot. What about our advisors' REM schemes? What should they look like? And it's a difficult one. Obviously, there needs to be a base that attracts advisors, retains them, but there needs to be something in there for them to be able to work towards. Even though we have to be difficult these days about what the regulators have said we can and cannot do when we link bonuses, but a good advisor in this country on a base salary of between 100 to 150,000 is the norm, with a bonus component of somewhere half of that, so 0 to half of that is about what's out there at the moment. We believe that the bonus portion should definitely, and so should the base, quite frankly, be directly linked to what the advisor is managing in terms of depth of client numbers, in terms of the revenue that they're managing on behalf of the firm. It can easily be switched to a fixed salary, but it should be based on something. But $175,000 for a principal advisor salary normalised. Sorry, I'm just trawling through a whole series of questions. I can't get to them all. I do apologise for that. Sorry, just wait one moment. Yes, the slides are definitely going to be available. How do you a couple have asked how we charge for our services. I might just put that down for a moment and answer a couple of others there. What's the average percentage of costs associated to labour in an FP practice? Oh, very good. Very good question. I can tell you now that the top 20% of firms in this country, so the top 20% of financial planning firms, and basically I've called them top 20%. It is a Peloton benchmark, but I have collated over 300 firms' data, some of the so-called best performing firms in this country that have either merged or sold, and a whole stack of firms that when I was doing M&A at SFG, I was charged to go and see and collate their information. What I found was that the top firms, so those firms consistently delivering at the high end of the profit margin spectrum, they had a labour cost as a percentage of revenue of 38%, no more, 38%. So 38% of labour cost to revenue. In the Peloton clients, so the 50 clients that we've been dealing with directly this past 3 years, their same number is 48% to 50%. So you can already see that there is a significant difference between the top performing firms who have a 38% labour cost, and by the way, they pay their advisors and their staff really well, but they also charge their clients really well, and they also make sure that they're only etching out a profit margin between 30 and 40%, no more but no less. That's driving and helps to drive that 38% labour cost. But some of my clients are at that 50%. I have one that's actually 72%, which is a huge cost. So add their other costs to it, and that firm, surprisingly, may not be a surprise to you, that firm is basically on the borderline of profitability. and needs help. But not everyone's like that, so 38% is the number. Yeah, sorry, I've been told I've got to finish up. There is a question about our costs, and I can tell you we charge a fixed fee for the first part of what we do, which is a consulting cost. So for that report, that iFocus report, it's $15,000 ex GST. We have some, I don't want to dob licensees in, but we have 4 or 5 licensees in this country that actually pay that on behalf of their member firms if they choose to do it. We have plenty of clients who do that themselves. For the second part, the iDeliver, that's a 12-month engagement. That's an investment. You're investing in a process that you can clearly see there is a return. We need to get that return. We charge a fixed fee plus a performance fee based on what we are able to deliver, get for you. And we must, and we only attach ourselves to ongoing revenue uplift from existing clients based on the client signing up to a package of services that makes sense for them, a fee structure that makes sense to them, that delivers that minimum profit to the firm. Fixed fee and percentage fee in the iDeliver phase. Folks, I'm sorry I couldn't get to anything, every question. There is too many up here to get to. I thank you so much for your time. I really value the fact that you've given up your time. I hope you found this some of this interesting. It is all factual data from clients. We don't spruik fake numbers. So this is actual firms, and we look forward to maybe catching up with some of you someday. Thank you very much for your time.
Hi Rob, thanks for sharing those insights, and we hope that everyone enjoyed the webinar today. We look forward to having all attendees attend our future webinar sessions, and our next one will be held on the 8th of March with Lonsec. Thank you.